Hello everyone, welcome back to my channel. And today I'll be starting with a whole new vertical for my channel, right? So, for the major part of this month, we have discussed a lot about finance, economics, business terms, and functions. And I wanted to start talking about things that almost every one of us come across almost every single day, but only some of us truly understand the economic or maybe the financial working behind them. So for today, we are going to talk about a very important tool in modern economy, which are credit cards. Right. So whenever we hear about credit cards, at the back of our mind, we are thinking about free flights, maybe a lot of cashbacks, maybe free lounge access, and a lot of free hotel rooms. Right. But have you ever sat down and wondered who is actually paying for these free flights or maybe your free hotel rooms? Do you think a aviation company would be giving you a free flight ticket just because you bought a credit card from a bank that the aviation company has nothing to do with? Right. So let's understand how actually the entire process of these credit cards exist and what is happening behind that. Right. So for getting our basis strong, let's first try to do a simple comparison. Right. Let's talk about a person A. Let's say he uses a very premium credit card. Right. And at the end of the year, he gets rewarded by the bank a rupees 80,000 international vacation just for using that premium credit card. Bank is actually rewarding him, right? Let's talk about person B. That person B only and only uses cash and absolutely gets nothing in return, no rewards, nothing. So what are you thinking about person A or person B? Who do you think the bank hates the most? Person A or person B? Your first guess might be person A, because just because he's using the credit card of that bank, the bank actually has to, in some way, pay him an 80,000 rupees reward for an international vacation, right? Whereas in person B, they have to reward him nothing, right? But do you think that's actually the scenario? I don't think so. So, don't you think that there is someone else who is actually paying these rewards to that person? Let's figure it out, right? So, what the common belief actually is that if I spend with my car, bank will notice how much I am spending, and somehow, for some reason, they'll be impressed by me and they will reward me, right? And everyone would be happy. But I don't see any reality behind that, right? It's obviously not true. So today we'll be understanding how cards actually work, why rewards exist in the first place, right? And who pays the merchants, what are the hidden fees associated with it, and who really funds these rewards, and ultimately why the richer people benefit more than the common people, right? So the concept of credit card started back in 1950, right? And it was the first charge card, and it had absolutely no rewards, right? How it worked, it was of Diners Club in 1950. It worked through paper signatures and was only acceptable for restaurant bills. It gave you absolutely no points, no miles, and no cashbacks. The core purpose for its creation was convenience and never the incentives, right? So rewards were added much more later. The original value for that particular charge card, right, or maybe the core ancestor of the credit card, was actually convenience and trust, and it was never ever about reward. But why do rewards exist today? For that, let's first understand the ecosystem of the entire modern card, right? First, we have the customers, which are basically you and me, right? Then we have the merchants, which are maybe could be shops or could be restaurants, right? Then comes the acquiring bank. Now, what is acquiring bank? It is basically the merchants bank, right? Then we have the card network. I'm sure you have read Visa or MasterCard in your card, right? These are basically card network companies, right? And then at last comes the issuing bank, which is basically your bank, right? So You don't have to figure out the connections yet. We'll just slowly and gradually pick each one of them and understand what is actually happening, right? Now let's go to the first steps. We'll follow the money step by step. See what is happening. Customer likes a pair of shoes at the store. It is worth 1,000 rupees. What customer does? He pays through a credit card. How much does he pay? He pays rupees 1,000, right? Now the money is moving. Now this is a very important slide. See what is happening in this. Customer is paying merchant, a shoe store, how much rupees? 1,000. But how much do you think the merchant would receive? I'll give you a hint. It is never 1,000 rupees, right? Never. It would be less than 1,000 rupees, right? Then the money would flow to the acquiring bank, right? So what happens? The merchant never actually receives the full amount, and it is because of a lot of fees and transaction costs that have been occurred during the process, and we'll talk about it slowly and gradually, right? So let's move to the next stakeholder of the network, which is the card network, which are basically Visa and MasterCard. So what Visa and MasterCard are actually in the business of, they are not in the business of issuing cards. They are just in the business of moving the information and never the money. They are basically the plumbing of the payment system. So what actually happens is, the customer swipes their card, the merchant requests authentication, the acquiring bank sends it to the network. What Visa and MasterCard do, it's they route the information, and issuing bank ultimately approves the transaction, right? So the hidden network is basically a middleman, right? And it helps in enabling the trust between the banks who don't know each other. So we are talking about issuing and acquiring banks. See, these banks would have no connection at all, but even then the transactions happen, right? So there need to be a middleman who is actually providing trust, who is authenticating the request, right? So this is where the card network like Visa and MasterCards come into picture, right? Now let's talk about the hidden fees, which is basically MDR. So when I talked about that, when the customer pays 1,000 rupees, the merchant might, or he usually does receive 980 rupees only. So basically the 20 rupees disappears somehow. That 20 rupees are nothing else but 2% MDR. Now what is MDR? MDR is basically the merchant discount rate, right? It is basically the fees that merchants pay to accept the cards, right? It is a charge, it's a transactional cost, right? So these 20 rupees is basically the 2%, it's the MDR. And what it does, these 20 rupees is split between who? Between the acquiring bank, between the card network, and most importantly the issuing bank, right? Let's see its bifurcation. So 1.5% of the not the 2% fees, but the amount, right? It's the total amount, right? It goes to the interchange, right? It goes directly to the bank of the issuer, who's actually of the customer, right? Issuer is the customer. This is basically what is funding your rewards, right? So 1.5% of, so basically 15 rupees is directly going, when the consumer buys that particular shoes, it is going directly to the customer's bank, right? 0.3% goes to the network fees, and 0.2 goes to the acquirer fees. This is basically the merchant banks. This is basically what helps the merchant's bank who is accepting the payment. It helps that bank keep running, and network fees are basically paid to Visa and MasterCard for routing all the information, right? So the largest slice actually goes to the bank that gave you the card itself, right? So it goes to the issuing bank. We have established that. So this is the money that eventually funds your rewards, right? So every time you earn miles or maybe cashbacks, it all comes from the interchange fees that the merchant pays on every transaction. So bank is giving the customer reward, right? This reward is actually coming from the money that merchant gave you when you purchase from him. See how it is all interconnected. When you pay the merchant is paying fees to a bank through which your reward is funded, right? So to understand the complete transaction flow, you buy 1,000 rupees worth of shoes. The merchant sends it to the bank. The acquiring bank processes, requests a process, and then Visa or Mastercard authorize the routes, and the issuing bank approves and deducts the amount. And whatever the reward is created, the points or maybe the miles are credited to your account, and every steps happen in seconds. The award appear days later, but the economics are baked in from the step one, right? But again, the biggest question comes into picture: why would a merchant be willing to pay MDR? MDR, the transaction cost, is basically benefiting the customers and never the merchant, right? So why do you think the merchants are willingly paying MDR, right? Merchants are basically businesses who absolutely hate fees, right? And they are accepting cards everywhere. But why? There has to be some hidden reason behind it, right? And the answer is actually customer behavior. What merchants often realized and experienced was that whenever a customer walked in who was willing to give cash payments, the average bill size was around 700. But that was not the case with the card. The average bill size was 1050 on an average, which is approximately 50% higher spending when they are using card. But why? See, whenever you are carrying cash, whenever you have to do a transaction, you first take it out of your wallet, you count your bills, you give it to the merchant, and it is actually painful because money, cash, is tangible, right? You can feel it go away. But putting a pin or maybe tapping your card is a lot less painful, right? You're not actually touching real money. You're not actually feeling the real money going out of your hands. You're just tapping a card in a machine, and this makes it a lot less painful, right? So this is where customer behavior comes in, right? The psychological pain of paying is much lower. And when see, the upgrades and impulse buying are also increased when we are talking about cards, because you don't have to count more money. You have to do the same process of just dabbing the card, right? The merchants are absolutely sure about this process, and this is the reason they happily pay the MDR so that they can access the higher spending customers, right? So this is the psychology of spending. Credit cards actually help in reducing the pain of paying, right? Research in economics actually show that whenever you pay with cash, your brains register it as a loss. But when you tap a card, the pain is dulled, right? So people spend approximately 15 to 30% more on average with credit cards versus cash. And I hope that even you realize that you are undergoing the same pattern as well, right? So this makes merchant accept the higher fees, right? Because higher sales is much more greater than the fee cost, right? So now we have created a very beautiful loop. See what is happening: whenever you're spending higher, you are actually giving the bank a higher percentage in interchange, right? And this is making the banks earn much more profit. When the banks are earning much more profit, they are rewarding you with rewards, or maybe miles, or maybe coupons. Those miles attract you, so you spend more. So ultimately you create a loop, right? So more spending encourages more interchange and more rewards to drive more spending ultimately. So this is a beautiful loop that has been created, and banks are basically focusing on rewards too much because they are not competing on interest rates alone, right? They are now competing on rewards, right? And the loop is just creating or reducing friction in the process, right? It is actually uh, a psychology that has been coming into picture, right? So the competition has eventually shifted to rewards, right? You're getting airline miles, you're getting cashbacks, launch access, insurance, hotel points, 5x to 10x points, accelerated earnings, right? So let's focus on airline for a moment, right? Because this is very, very interesting. When we're talking about the airline company, how it actually gives out miles is like airline basically sell points to bank at a discount, right? The bank is buying millions of these points. So realize this, a cash transaction, airline is getting money. Understand this particular point. This is very, very important. This is very, very important and very, very smart. Airline got its money. Customer basically earns point on whatever he spends, and a traveler basically redeems it for a free flight, right? Now, free flight, did the airline get the money for the miles or not? Yes, it did. Did the banks benefit? Yes, they did, because they were able to buy these points. They kept some for themselves, and then they lent out to get the rewards from the rest. Right. So customer who eventually became the traveler is basically getting that flight for free. But neither the aviation company nor the bank is losing. Right. And neither the customer is losing. Right. But why is it very, very important for the airline is because airline are getting cash, that too upfront, for seats that might otherwise fly empty. Let's say we are flying a plane with a capacity of 100, and a day after tomorrow maybe it is expected that the occupancy would be 98, and let's say the two seats were already sold to the bank in form of miles, right? So airline has already got the money for these two seats. Now if the customer comes, that's too okay, and if it doesn't come, that's too okay. The airline is benefiting. Airlines are actually, maybe the occupancy is at 98, but because he already sold those points, they are actually flying at the 100% capacity revenue wise, right? Maybe at a discount, but at 100% revenue, maybe a little low, right? So they are basically getting cash today for the potential future seats. They fill seats that would fly empty anyways. This actually creates customer loyalty to the airline as well. When the customer is regularly getting free miles for a particular airline, he might get attached to the process of that particular airline and actually become loyal for that airline, right? The low marginal cost, the seat was going away anyways, right? So they preferred selling it at a discount, right? So the major underlying belief for that particular airplane miles is that unused seats are perishable inventory. Once the plane take off, an empty seat equals to zero revenue. So rather than getting a zero revenue, a 50% revenue from that particular seat is much more generous, right? So what happens? Annually, customer is spending 10 lakh rupees. The interchange earned at 1.5% is 15,000. The rewards that are given to customers ranges between 8,000 to 12,000, and that too if they redeem them. But ultimately, bank have to purchase them, right? So basically, what is happening? They are getting a 3% spread, right? So bank is also benefiting, right? So net revenue, they are still profitable for the bank's perspective. So the customer, are they paying for the reward? No. The bank, no, they are actually profiting. The merchant, partially, they pay the MDR. right? Which is basically the fuel for the revenue collection, right? Consumers. Why do I say consumers? Yes, they pay through higher prices. Let's understand this, right? See, what is happening is merchants have to pay MDR, right? Now, the problem is the MDR is paid only on card transaction. So, if the merchants start charging the card customers 102 rupees instead of 100 rupees, the card customers would actually prefer paying through cash, right? And the entire concept goes to waste. So usually what happens is the price are now changed to 102. So even if you are a cash customer, you are paying 102 rupees. You are also paying 102 rupees. The merchant raises prices for each and every one so that the MDR costs are covered, right? And this is the hidden subsidy. See, cash paying customers who never actually earn the rewards are basically subsidizing these premium rewards for the card users. That's why consumers, through paying higher prices, which eventually makes the merchants comfortable in paying the MDR as well, right? So what happens is cash buyer is actually paying the full price, right? Cash buyer is actually paying the full price and gets absolutely no reward. Merchant revenue, it includes MDR cost at all prices, right? So the MDR transaction cost is not actually hurting him that much, right? Then the swipe fee is paid to banks and the networks. Issuing banks collects the interchange, which is the higher portion of that MDR. Then premium rewards are transferred to card holders who are having premium cards, right? So basically cash users are quietly funding the vacations of the premium card holders. Are you now able to understand what is actually happening? So who is actually benefiting the most? The higher income. See, they are the one who own the premium credit cards. They are the one with the annual high spend. They earn the maximum rewards, right? They get free flights and lounge access, and this is how they are benefiting from the subsidy that basically cash consumers are giving, right? So lower income group, what is actually having, they are most prone to using cash or debit card, right? They have basic cards to none. They actually pay the full price or maybe a little higher, right? They are the actual stakeholders who are subsidizing the system, and they are the one to rarely, not rarely, they never benefit or get any rewards, right? Unless and until there is a cash discount. That too in case of wholesalers, where credit cards are not even considered, right? So this is pure economics, no politics at all. The system transfers value upwards and upwards only. You have to understand this particular thing. So cash buyers are basically funding the merchants revenue. Merchants revenue is basically funding the MDR or the swipe fees is actually going to the issuing bank. The issuing bank is basically giving and producing or buying premium rewards, and the premium rewards are being cashed out by the affluent travelers, right? It is simple, it is powerful, and most importantly invisible to most consumers, right? So let's say an average coffee price is of 300 rupees, and MDR of 2% would be a 6 rupees per transaction. So transactions per day, let's imagine it's 500 rupees. So daily MDR paid is 3000 rupees. Let's say there are 10,000 such stores in the city. So annual MDR would go up to this big amount. Started from 6 rupees to 10 crores 95 lakh. This is the power of volume. Multiply that across thousands of city and millions of merchants worldwide. This tiny percentage actually become billions in economic transfer. And let's see how different countries handle this differently. In United States, the interchange rates are higher. So basically, The reward ecosystem is very rich, right? So the premium cards are actually able to thrive. In Europe, due to EU regulations, there are cap on interchange percentage, right? So the rewards tend to be lower because they don't have actually money to invest in these rewards. So there is more cash or maybe debit card usage. In Australia, the regulations are quite heavy, so the interchange is automatically reduced. So rewards are scaled back significantly, so they enjoy little to no rewards. In India, with RBI regulation plus the UPI competition, RuPay is being pushed, and premium cards are still a strong for international trips or maybe rewards, right? Now, talking about India particularly, it is actually a very unique battleground. See, we are actually having the benefit of RuPay, which is basically a domestic card scheme with a lot less MDR, right? And it is promoted by RBI and NPCI. We also have an excellent network of UPI, which is basically account to account payments with actually very low to no MDR at all, right? And it is actually disrupting cards, right? The credit cards still use 1 to 2% in MDR, and debit and RuPay often charges quite lower, right? And UPI is actually near zero. Talking about premium cards, they are still popular for international travel, launch access, and high rewards. So, when we're talking at with the prospect of customers, they are getting convenience out of it, right? We are talking about customers who actually own the credit card. They get convenience out of it, they get rewards, and they get credit float, right? You have to pay after 30 or 45 days. The merchant is actually having a higher sales volume because the pain of paying is reduced. Visa and MasterCard basically charging network fees on massive volumes of these trades, right? The issuing bank is actually earning interest rate plus the interchange rate plus the interest rate and the fees. Interest rate in case the customer defaults or maybe will not able to pay within set amount of time. Talking about airlines, they are basically getting advance cash for future seats. They are also benefiting from this. So this is actually a very beautifully designed economic system, but the problem is not everyone is willing equally, right? Who are hurting from this process the most are actually the small merchants who have actually very razor thin margins, right? Which basically makes the MDR very hard to absorb. A lot of cash users are actually ending up paying higher prices, but they receive absolutely zero reward, right? Then we talk about low spenders. They are basically people who are not qualified for premium cards, and because of that they are getting zero to no rewards, right? Then we have the revolving debtors. So who are not able to pay their dues, they are basically getting trapped in interest rate traps, right? And basically rewards are not enough to offset their debt cost, right? So rewards are never free, right? There is no such thing as a free lunch. This is the most important economic principle that you have to understand, right? Someone somewhere is always paying. In this case, it's often the person paying cash or the small merchant with very tight margins, right? So what if rewards disappear, right? Let's just think about it. Would there be lower fees? Possibly, because merchants might negotiate harder. Why? Because you don't have to create a very big pool to buy rewards, right? So merchants would negotiate just to reduce their share. Lower prices, possibly, because MDR savings would eventually be passed to the customers because they were the first tool to extract that cost from. The competition would be on something different. Yes, of course, they might start to compete on interest rates and fees instead, right? Would cash come back because of that? Actually, this is quite unlikely because convenience is getting way too strong, right? The way the economies and the human psychology is moving, we are actually preferring convenience over cost, right? So the system is actually quite deeply embedded at this moment. Whatever changes would come would be slow and quite complex, right? So what is the future of rewards, right? So new technologies could definitely bypass the traditional card rails with lower fees, faster settlement, and less need for rewards as an incentive. Will the reward survive? The economic logic may evolve, but the fundamental truth remains same. As long as someone is okay being exploited and someone is paying the fee, someone is getting trapped, you will always have someone to pay for your vacations, right? We are also experiencing UPIs. We are also getting CBDCs. These are central banks digital currencies. Then we have the account to account payments, right? Remember that person A and person B comparison that we did earlier. See, person A was able to get 80,000 international vacation, and person B who paid in cash got nothing. But who quietly helped them fund that vacation? The cash paying customer, the customer B at that very merchant was able to fund that reward. The small business who was absorbing the MDR, the low spenders who never actually qualify for the premium perks, they are giving out, uh, basically funding the entire uh, portfolio, which eventually would reward the rich people, right? And now the illusion is complete, and now you are able to see the entire system, right? So now from every time, whenever you see 5x rewards, maybe free flights or unlimited cashback, remember, banks never create rewards, the economic systems do. Every reward has a cost. Someone somewhere is paying for it. Now you know who. Thanks for watching, and from now on start questioning everything